Buyurun hocam, birazdan başlayabilirsiniz.
Okay. Hello, everyone. Good morning, good afternoon, and good evening, wherever you are. Welcome to our last lecture on derivatives. This week, I'm going to discuss options. As usual, let's start with a brief discussion on swaps that I covered last week. Before I go into my lectures, I'm going to stop my video in order to avoid any connection disruption. Last week, I talked about the third building block of derivatives, so-called swaps. We define swaps as agreements between two parties to exchange cash flows in the future according to a pre-arranged formula. Swaps, therefore, may be regarded as a portfolio of forward contracts. Swaps serves as an effective hedging vehicle in much the same way that financial futures contracts do. Swap agreements have also become a popular vehicle for speculation on interest rates, forex, and commodity swaps. We discussed how to use swaps in these markets last week. So this week, I am going to talk about options. I will start with what we mean, a definition of an option. Then I move to discussion of the mechanics of options by looking into very simple call and put option. We will discuss how and what purposes these options are used, especially in commodity markets. I will finish this week's lecture talking about how to use options for hedging purposes. As I said, this week we are covering options. An option gives the option holder the rights or option, but no obligation, as opposed to futures contract. It gives the right to buy or sell a security to an option writer for a pre-specified price, what we call this price as strike price, and at or up to a given time in the future. We call it expiry date or maturity date. In exchange for the rights, buyer of the option pays a premium to the seller of the option. Therefore, an option has positive value as opposed to forward contract, which has zero value at its inception. A call option gives the holder the right to buy a security, and a put option gives the holder right to sell a security, where the underlying interest is represented by a futures contract. The right to buy is actually the right to be long on a futures contract at a specified price level. Conversely, the right to sell represents the right to a short future position at a specified price level. Options allow one to take advantage of changes in future prices without actually having a position in futures markets. A call option buyer will only choose to exercise if the stock price is greater or higher than the strike price. If the stock price is less than the strike price, the investor would clearly choose not to exercise the option, and the investor only loses the option premium. On the other hand, a put option buyer will only choose to exercise the option when the stock price is less than the strike price. If the stock price is more than the strike price, the investor would clearly choose not to exercise the option and would only lose the option premium. Options can be American, European, or Bermudan. American option can be exercised at any time prior to expiry. European option, for example, most of energy option traded on CME are American options. European option, on the other hand, can only be exercised at the expiry. When the expiry comes, you have to decide whether to use your right or not to use. On the other hand, Bermudan option can only be exercised during a specified period. You define the period you can use your exercise to get the option or not. The price at which the futures contract underlying an option can be purchased, in this case, call option, or sold. This is called strike price. In the call and put, we are talking about predetermined price. It is important to note that for every option buyer, there is an option seller. At any time before the option expires, the option buyer can exercise the option. Since the buyer decides whether to exercise, the seller cannot make money at expiration. To take this risk, the seller is compensated by the option premium, which is agreed when the contract is signed. The option premium is determined through trading on an exchange market. Therefore, we should expect to see different option premia for different strike price. While strike price does not change, but the option premium fluctuates during the day. Effectively, the exercise of a call gives to option purchasers a long position when we talk about the futures market in the underlying assets at the option strike price. The exercise of a put option gives the option purchaser a short position at the option strike price. The option buyer can also sell the option to someone not and let the option expire. The choice of action is left entirely up to the option buyer. The option buyer obtains these rights by paying the premium to the option seller. The option seller, on the other hand, receives the premium from the option buyer. If the option buyer exercises the option seller is obligated to take the opposite futures position at the same strike price. Because of the seller's obligation to take a future position, if the option is exercised, an option seller must post a margin and faces the possibility of that margin will be called if the market moves against the potential future position. The person who sells a call or put option and receives the option premium is called guarantor. Basically, we are talking about the person who establishes a short position. This party is obligated to perform under the terms of option if the option buyer exercise his rights to the option. When we talk about exercise, the exercise of a call gives the option purchaser a long position in the underlying futures contract. or long position in the assets at the option strike price. The exercise of a put option gives the option person a short future position at the option strike price. What assets an exchange traded option, we can have options. Option can be on stocks, can be on ETF, can be on foreign currency or stock indices, or futures contract. That is all available. For example, in the futures, because there is no option on crude oil, we see option on crude oil futures rather than crude oil itself. But during the contract specification, you have to specify the expiration dates, strike price, whether it's a European or American or Bermudan. And then you have to specify also whether it's a call option or put option. Let's look at here, for example, Apple option. That is June 29, 2020, and the option expires July 24, 2020. As you see, we have the call option, we have the strike price, 335. The current price for Apple at that time, of course, 361. The strike price, 335. And then, of course, option premium, you can see at the last $31.20. For strike price of 337.5, the option premium is 26. And the strike price of 360, option premium for call option is 12.92. For the put option, on the other hand, the option premium is 11.70 cents. Call option, let's look at more detail. Call option is a contract where the buyer has the right to buy, but not the obligation. Since the buyer decides whether to buy, the seller cannot make money at expiration. To take this risk, as I said, the seller is compensated by option premium, which is agreed when the contract is signed. Let's consider a call here, special and rich index with 6 months to expiration and strike price of $1,000 and premium of 93.81. And let's assume that the risk-free rate is 2% over 6 months. Suppose that the index in 6 months is 1100. In this case, clearly, it is worthwhile to pay $1,000 strike price to acquire the index worth 1100. If, on the other hand, the index is 900 at expiration, it's not worthwhile paying the $1,000 strike price to buy the index, because you can buy the index at a lower price in the marketplace rather than paying $1,000. All you lose, basically, the option premium. Remember, also, the buyer is not obliged to buy the index, hence will only exercise the option if the payoff is positive. In this case, a purchase call payoff is maximum of 0 and the difference between spot price minus the strike price. In our example, for example, strike price was $1,000 And then if spot price turns out to be $1,100, then the call payoff is maximum of 0 and 100, which is, in this case, the maximum is 100. Therefore, I will exercise my option rights. If, on the other hand, spot price turns out to be 900, then the call payoff is basically, it is maximum of 0 and minus 100, which is 0, of course. Therefore, there is no exercise. So you let option to expire itself. And therefore, the payoff is 0. Payoff does not take into account, of course, the initial cost of acquiring the position. For a purchased option, the premium is paid at the inception. In computing profit at expiration, we need to use future value of the premium. Therefore, for a purchased call profits, it is just the payoff minus future value of option premium. Here, let us, if the index at the expiration is 1100, then our profit is maximum of 0 and 1100 minus 1000 minus 93.81, which is the option premium, times 1.02. This is the interest rate, you remember. This is the 93.81 times 1.02. It's the future value of option premium. Therefore, the purchase call profits would be $4.32. If the index is that expiration is 900, then the owner does not exercise, or option buyer does not exercise the option. The loss will be future value of option premium. The maximum loss will be the option premium, which is 95.68. Remember, 93.81 option price, then you need to calculate the future value of this premium, which is 95.68. If we graph the call payoff, we computed the payoff on option as a function of price. The graph here shows optionality of the option. Below the strike price of 1000, the payoff is 0, since option is not exercised. It is better to buy the index at a price in the marketplace. However, the payoff is positive and increasing above the strike price of $1,000, since the option buyer exercises right to buy the asset, since strike price is below the current market price. Here, we calculated profit. Profit is calculated as the difference between call payoff and future value of option premium. If option is not exercised, a call buyer would suffer only from the loss of premium. Call buyer exercises right to buy when the current price is higher than the strike price. However, call buyer still makes loss until the index price reaches strike price plus future value of premium. In our example, it was $1,095.68. You can clearly see the difference between forward call contract and call option here. Profit and payoff are different for an option by the value of future value of option premium. For the long forward, both payoff and profits are same. You have limited risk in downturns with options. However, your risk is the difference between forward price and the spot price in forward contract. Your benefit in both cases for the option and forwards are unlimited. Let's look at on the option seller side. We have the option buyer who has the right to buy the contract. And then, of course, there is always a counterparty who is writing this option, what we call is option, written option. For the option writer, basically seller of the option, has a short position in a call option. The writer receives the premium for the option, then has an obligation to sell the underlying security in exchange for the strike price if the option buyer exercises the option. The payoff and the profits to a written call are just the opposite of those for a purchased call. In the case of payoff, it is just the minus the maximum 0 and spot price minus K, or minimum of 0 and the difference between strike price and spot price. And the call profit, of course, it is minimum of 0 or strike price minus spot price plus the future value of option premium. In our example, for example, if spot price at the expiration is 1100, then option writer payoff will be $100, and the profit will be $4.32. If, on the other hand, S is equal to 900, where our option buyer will not, do not exercise his right, then the payoff will be 0, and the profit will be the future value of option premium, $95.68. As you see, for option writer, the maximum benefit he gets is the future value of premium, $95.68. Here, again, we graph the payoff for option, call option writer by computing the payoff on the option as a function of price. Below the strike price of 1,000, the payoff is 0 since the option buyer will not exercise his rights. It is better for the option buyer buys the index at lower market price than strike price. However, as price passes strike price, option buyer exercises his right, option writer obliged to fulfill the agreement. The payoff for the option writer is the mirror image of buyer payoff. Here we just graph profit for the option writer. As you see, again, just the mirror image of option buyer. Let's look at second simple option contract, which is the put option. A put option is a contract where the buyer has the right to sell, but not the obligation. Since the buyer decides whether to sell, the seller cannot make money at the expiration. To take this risk, the option seller, put option seller, is compensated by option premium, which is again agreed when the contract is signed. Let us consider again an special and rich index, put option on the special and rich index with 6 months to expiration and the strike price of $1,000. And the premium of option premium is 74.2. As you see, option premium for put option and call option are different. And assume that the risk-free rate, again, 2% over 6 months. If we suppose that the index in 6 months is 1100, clearly it's not worthwhile to sell the index worth 1100 for the strike price of 1000, because in this case, option buyers, put option buyer, is better off selling its share in the marketplace for a price of $1,100 rather than price of 1000. If on the other hand, the index is 900 at the expiration, strike price offers the option buyer, put option buyer, a much better price. So he will exercise his rights. Remember again, the buyer, option buyer, is not obliged to sell the index, hence will only exercise the option if the payoff is positive. For purchased, put payoff is just equal to maximum of 0 and strike price minus the spot price at the expiration or just before the expiration. In our example, for example, we have strike price of 1000 and strike price, strike price is 1000 and spot price, let's say that it is 1100. Then the put payoff is going to be 0 because option buyer will not exercise his right. Instead, he will go and sell his share at the market price of 1100. If on the other hand, spot price at the expiration turns out to be 900, then the put payoff is going to be, of course, 100. It is the maximum of 0 and difference between strike price and the spot price, which is 100. Of course, in this case, you are exercising your right to sell. And of course, here again, like call option, payoff, in calculation of payoff, we are not taking into account of the initial cost of acquiring the position. For a purchased option, the premium is paid at the time of the option is acquired. In computing profit at expiration, we need to use again the future value of premium. So purchase put profits will be equal to maximum of 0 and strike price minus spot price minus the future value of option premium. Basically, it is same logic as call option. To calculate the profit from option, if the index is at the expiration is 1100, then the option buyer will not exercise. The maximum loss will be the future value of option premium. He is going to lose option premium, which is $74.20, and then I need to calculate the future value of $74.20 at an interest rate 2% for the whole 6 months, which is $75.68. If the index at the expiration is 900, then of course the owner, option buyer, exercise the option. The profits will be purchased put profits is just going to be equal to $24.32, which is the payoff minus the future value of option premium. Here again, like call option, we put the graph for the put payoff. If the market price below strike price, option holder will exercise his rights. If the price is above strike price, option has no value in the sense that option buyer sells his shares in the market at a higher price than strike price. Therefore, the payoff to the option buyer is 0 after the strike price at a higher price than strike price. But if the price is very low, of course, for option payoff is much, much higher because you prefer to sell your option share at a strike price, which is offering much higher. here again, we have put option profit. You just need to take into account put premium. So this is very similar with the call option. How about the payoff and profit for a written put option? Because as I said, for every option, there is a buyer and there is a seller. Put option, you buy the right to sell an assets or underlying futures contract. And then of course, there has to be someone who is writing this contract. It's what we call option writer. It's the seller of the option, has a long position in a put option. The writer receives the premium for the option and then has an obligation to buy the underlying security in exchange for the strike price. If the option buyer exercises the option. If the option buyer does not exercise, maximum benefit he gets is the option premium. The payoff and the profits to written put are just the opposite of those of purchased put. Written put payoff is just a minimum of zero and spot price minus strike price. You remember for the purchase put payoff is the minimum of 0 and strike price minus spot price. It's just the opposite here. Written put profits, on the other hand, you just need to add the future value of option premium because you are the receiver of option premium. In the option buyer case, we were deducting future value of option premium from your to calculate your profits from the payoff. In our example, for example, if spot price at the expiration is 1100, then the put buyer will not exercise the put. Thus, put writer earn profits at the amount of option premium. If on the other hand, spot price at the expiration is 900, which is lower than the strike price, then the option buyer will exercise option, and option seller writer will lose $24.32. This is basically he's getting $75.68 future value of option premium, but he's making a loss of $100 from the exercise, so he lose about $24.32. Let's a little bit talk about moneyness of option. Options are generally referred to as in the money, at the money, or out of money. The moneyness of option depends on the strike price to spot or price of the underlying assets. An option is said to be in the money if the option has positive value, if exercised right now. So call option is in the money when strike price is lower than the current underlying price. Put is in the money when the strike price is higher than the current underlying price. Sometimes it's also defined in terms of forward price at the same maturity in the money forward, for example. If forward price is greater than strike price, we call option is in the money. For the put option, FT, forward price should be less than strike price. The option has positive intrinsic value, defined as the maximum of 0 and the value of option would have if it is exercised today when in money. The intrinsic value is just ST minus K for the call. K is the strike price, minus spot price for the put option. Of course, you can also define an intrinsic value in terms of forward price. So there is not much difference on that one also. An option is said to be at the money when the strike price is equal to the spot price. So call is at the money when the strike price is equal to current underlying price. Likewise, put is also at the money when strike price is equal to current underlying price. Also, as in the money, you can also refer to at the money comparing strike price to forward prices. An option, on the other hand, is said to be out of money when it has zero intrinsic value. So call is out the money when the strike price is higher than the current underlying price. Put is out the money when strike price is lower than the current underlying price. I defined this one a little earlier. What kind of assets we can have options on? First, of course, stocks. Most trading in stocks option we are seeing is on exchange right now. Of course, there are this contract gives the right to buy or sell 100 shares at the specified strike price. For example, Chicago Board of Option trades many exchange-traded products, ETPs. ETPs are listed on the exchange, on an exchange, and traded like a share of the company stock. They are designed to replicate the performance of a particular market. For example, just think about crude oil or silver or gold. The most common ETP is an exchange-traded funds. This is usually designed to track an equity index or a bond index. There are lots of ETPs on the commodities as well. Other ETPs are designed to track the performance of commodities and currencies, as I said. And then we had the options on foreign currency. Most currency options are trading now in the over-the-counter market rather than exchange-traded. As I said, the current biggest options in the over-the-counter market after interest rate is the foreign exchange. For example, we have the Nasdaq exchange offers European-style contracts on a variety of different currencies. One contract is to buy or sell 10,000 units of foreign currency for US dollars. And then, of course, we have the options on stock indices or indices, many different index options currently traded throughout the world in both the over-counter and, of course, also exchange-traded markets. For example, we have index option on S&P 500 and the S&P 100 or Nasdaq, and the Dow Jones Industrial Index are very popular. All of these trade on the Chicago Board of Options Exchange. Most of the contracts are European, but as I said, can be American also. One contract is usually to buy or sell 100 times the index at the specified strike price. Settlement is always cash rather than by delivering the portfolio of underlying the index. And the last one, which I'm going to talk a little bit more, futures. Options on futures. Like, as I said, there's no futures on crude oil. Sorry, there's no options on crude oil itself. There is an options on crude oil futures. When an exchange trades a particular futures contract, generally, it often also trades American options on that contract, here in USA especially. That is, they can be exercised at any time during the life of the contract. The life of the futures option normally ends a short period of time before the expiration of trading in the underlying futures contract. Standardized exchange-traded futures options are exercisable into 1 futures contract. Let's look at some detail in the options on futures. As I said, a futures option is the right, but not the obligation, to enter into a futures contract at a certain future price by a certain date. When a call futures option is exercised, the holder or the option buyer acquires a long position in the underlying futures contract plus a cash amount equal to most recent settlement price minus the strike price. When a put option exercised, on the other hand, the holder acquires a short position in the underlying futures contract plus a cash amount equal to strike price minus most recent settlement price. Remember, again, there is no option contract on crude oil or other commodities. Options on commodities are on the futures contract. Futures options generally are referred by the delivery months of the underlying futures contract, not by the expiration month of the option. As I said before, most futures options are American, so the expiration date of a futures option contract is usually short periods of time before the last trading day of the underlying futures contract. For example, nearby WTI futures trading terminates 3 business days prior to 25th calendar day of the month prior to contract months. If the 25th calendar day is not a business day, trading terminates 4 business days prior to 25th calendar day of the month prior to the contract month. On the other hand, option, WTI option terminates 7 business days before the 26th calendar. Basically, there are 3 or 4 days differential between the expiration of the option and expiration of future contract. Future contract expire later date than the option. Here, I just look at this one, get the data from CME on July 2nd, 2020 for the August WTI American option. Of course, you can have September, December, whatever option, you can have it. Here we have the strike price in cents. Of course, it is 3,500 means $35. We say, of course, here current, at that time, current WTI contract settlement price 40.65. If for call option, if strike price is greater than, if strike price is lower than price, then we call it option is in the money. So I put the green color over there. So for example, for a strike price of $35, option price is settled $5.9. For a strike price of $40, the option price is $1.79 for call option. Similarly, for $40, strike price has a price of $1.14 for the put option. Let's suppose it is July 2nd and a trader has one August futures call option contract on WTI with a strike price of $35 per barrel. One futures contract is, of course, on 1,000 barrels of WTI. Suppose that the future price of WTI for delivery in August is currently $40. And at the close of trading on July 1st, which is a day before the last settlement price, it was $39.82. If the option is exercised on that day, the trader receives a cash amount of 1,000 times 39.82 minus 35, which is about $4,820 cash, plus a long position in a future contract to buy 1,000 barrels of WTI in August. Of course, option buyer, this is a call option buyer, if he desires, he can close his future position immediately by going short one contract in WTI. This would leave the trader with the 4,820 cash payout plus an amount 40 minus 39.82, 180, reflecting the change in the future price since the last settlements. The total payoff from exercising the option on July 2nd is $5,000, basically, which is equal to 1,000, which is the barrel, times the future price, F minus strike price. Future price was about, strike price, you remember, we put 40, and then future price, well, what was the future price? 40, yes, sorry, $35 strike price and then $40 current price, so it is going to be $5,000. How about put option? Let's suppose again it is July 2nd and trader has one August future put option contract on WTI with a strike price of $43 per barrel. One future contract is on 1,000 barrel of WTI. Suppose that the future price of WTI for delivery in August is currently $40. And at the close of trading on July 1st, this last settlement price was 39.82. If the option is exercised, because strike price is higher than the spot price, therefore the trader receives cash amount of $3,180. This is the 43 minus 39.82 times the number of barrels, plus a long position in futures, plus a short position in August WTI contract. So if he desires, of course, the position in the futures contract can be closed immediately by going, because now initially you are short, now you need to buy a long contract on WTI. So at the end of the game, if you immediately close your position, your payoff from the put is going to be strike price minus future price times the number of barrel, of course. Strike price, you remember, 43, and the future price, which is about 40 or something, then you have $3,000 payoff or the profits. So let's finally talk about how to use options on futures for hedging purposes. Of course, you can use this option for speculation purposes as well, but let's talk about how we can use these tools to hedge our position. Hedge can be established by buying or selling call or put option. And of course, you can do by a combination of these two. However, the concept of short and long hedge does not apply in option because of the contract specification. It is the right rather than obligation, all this stuff. Here, let us look at again, this is the July 2nd, again, December 2020 contract settlement price was 41.11. On July 2nd, again, we have the American option prices for different strike price. We have different settlement or option settlement price, basically option premium. For example, $35 strike price, option premium for call option, $8.49, for the put option, $2.38. And you can see the open interest and you can see the volume of trades. And here we have prices up to 100, but if you go there, you can see even you have negative prices. So negative price, you remember from the episode of April 22nd episode, WTI prices went down to minus $37 or something. All right. Let's look at our case here. We are trying to hedge our position. Let's look at an example. You own an inventory. Basically, you are an oil producer. When you try to take a position to hedge your cash position, you need to ask yourself several questions, actually. First question is, you need to ask is whether the risk is limited or unlimited. Or if risk is limited for any strategy, how much? And the second is whether the reward, the benefit is limited or unlimited. If reward is limited, then how much? Then the last one, of course, you need to ask yourself, what are the break-even points? Let's consider you are a shale oil producer and expecting to produce and sell 1,000 barrels of oil next December. Assume that the December future contract is currently trading at $41. You remember here. 41.11, but assume it is 41. And you are worried about the possibility of falling prices due to permanent damage coronavirus might have on oil demands. You want to hedge against falling prices. How can you protect yourself from falling prices? What is the reward and risk for your strategy? And how about the break-even points? The first strategy is very simple. Owning inventory or current or future inventory requires establishing a short position in forwards or futures, which will profit to you if prices fall. This is called short hedging. You are guaranteed to sell your oil at $41, whatever the price turns out to be in December. This is actually your obligation, unless you close out your position earlier. If prices falls zero, you are able to sell your oil still at $41. So ignoring prices in the negative territory, that is also possible. As I said, in April, we saw negative prices, but it is very rare. But let us assume non-negative prices. Your maximum gain is the forward price. If you allow negative prices, of course, your maximum gain is unlimited also. However, if prices rises above future price, you can make loss from your hedge in the sense that you are required to sell your oil at a lower price than the market price. Your loss is unlimited. If, let's say, the market price turns out to be $200 because there is a big war going on, and then prices suddenly jump. But you are obliged to sell your oil at $41. So your benefits is limited by the forward price. And then your loss is unlimited, depending on the future price and how many contracts you are holding. Here, a short hedge mitigates risk from falling prices. It is protecting you against any kind of falling prices. It also removes the possibility of gain. If price turns out to be equal to future price, you don't make any profit or loss relative to current price or the spot price at the expiration. So this is also your break-even points. You have to decide whether you choose this strategy or not by looking at the reward and risk and break-even. Here the reward is forward and future price in the downside, and the risk is unlimited in the upside. I am assuming again here when I say downside, your reward is limited forward, but if you include the possibility of negative prices, your reward becomes also unlimited because you don't know whether how much it can go down. We look at April episode, it went down to minus $40, and then of course this is a big possibility. In that case, of course, your rewards basically, I mean, your risk also in downgrade is your reward is also changes. Alternatively, you can buy a put option. Here, second strategy is to buy put option, which gives you the right to sell your commodity or short position in WTI futures contract it gives you. Consider again a trader. You can who thinks that oil prices are going to move substantially higher in the near future and wants some protection. In this case, the trader might buy a call option. Let's go back to our put option stuff. You are buying a put option. You are a shale oil producer. Basically, in this case, your reward is unlimited in downside, considering, of course, negative prices. But you have very limited risk, limited to the premium you paid, and break-even points in this case is just the strike price minus the premium. Or in a third alternative, it is the same thing. Basically, this is short position in futures, buying a put option, or selling a call option. Basically, here you are choosing to sell December WTI contract in lieu of buying a put option. In this case, reward is limited to premium received. Risk is, and the upside is unlimited. Break-even point is just the strike price plus premium. So you have to choose based on your reward and risk profile, which strategy you go, whether you are going to establish a short position in futures, or you can buy a put option, which gives you the right to sell. And of course, eventually, if you exercise, it gives you a short position in futures market at a strike price, or you can sell a call option for the hedging short cash position. Let's say with futures, you can do basically can establish a long position in futures. Let's say you are an airline company here. You want to buy some oil in the futures. How can you protect yourself from rising prices? Then you can establish a long position in futures, which will gain if prices rise. So it should be long hedge, not the short hedge over there. And alternatively, a hedger who holds short position could buy a call option. Again, in this case, reward is unlimited profit in the upside. Risk is limited to forward premium paid. You just pay forward premium, and then if you don't exercise, all you lose is the forward premium paid. And the break-even point here is the strike price plus the premium. Or you could sell, or you could write a put option, which is we call written put. Reward here limited to premium received in the upside. If prices are moving up, then the risk is unlimited on the downside. Break-even point is the strike price minus premium price. So basically, there are several different options to hedge yourself against market movement. Of course, you can use combination of these put options and call options all together, different strategies. But at the end of the game, you are betting on volatility rather than prices itself when you are dealing with option trading, as opposed to futures. It is about actually prices itself. So hopefully this 5-week lectures gives you some idea of course, derivatives markets. It is just the introduction of derivatives market. We first covered forwards, then we moved into futures, then we discussed swaps, and we ended our discussion with option prices. Hopefully these lectures help. Thank you so much for listening and having me in your room for the last 5 weeks. Okay, thanks a lot. Gökberk?